You are listening to The Vocal Technologist. Spoken Tech for your ears.
You know, some weeks I feel like I need a whole research team just to track the digital asset space.
It's a lot.
It's information whiplash. 1 minute, it's all about global institutions finally getting on board, and the next, you're looking at these incredibly strict new regulations.
And that's the central tension, isn't it? Everything we're seeing confirms it. The whole narrative is these two massive forces.
Exactly. Big money coming in.
And governments trying to build the fence around it fast.
So that's our mission today on Vocal Technologist. We've waded through all the critical reports, the regulatory moves, the product launches, the tokenomic shifts to give you a clear, concise view of what actually matters.
It's about charting that path from the Wild West to what's becoming the new economic reality.
Okay, let's start with the rules then. We have to talk about the Bank of England. That was a huge surprise.
A very big surprise. These new holding limits for sterling stablecoins.
And they're temporary, but £20,000 for an individual, $10 million for a business. A £20,000 cap barely covers a down payment on a small flat. Are they really saying this is an existential threat to commercial banking?
Well, Deputy Governor Sarah Breeden basically argued, yes, it is about protecting the stability of the banks.
The ones handling mortgages and all that?
Exactly. The sector that underpins the entire UK mortgage market, their demand and guarantees. The backing structure is incredibly specific.
I saw that. 60% in short-term UK government debt.
And the other 40% has to be held in Bank of England accounts. They want zero risk.
Which brings up the big question, is this protection or is it control?
Well, it's a fine line. To be fair, the framework only applies to systemic sterling stablecoins, so the big ones used for retail payments. But it definitely sets a very high bar.
Okay, so let's jump across the pond to the U.S., where the regulatory picture is just a total jigsaw puzzle.
Incredibly messy is a good way to put it.
You've got the Senate Agriculture Committee with this draft crypto bill trying to give the CFTC oversight of spot markets.
But the political infighting is just intense. There are disagreements. Senator Warren is pushing back hard.
So the timeline is slipping.
It's slipping badly. We're probably not looking at a final vote until, maybe Q1 2026? Congress moves slow.
But, and this is the crazy part, even with that stall, we're seeing huge policy shifts happen right now.
That's the key. Acting CFTC Chair Caroline Pham isn't waiting. She's using existing authority to push for leveraged spot crypto trading on regulated U.S. exchanges.
Like CME or Coinbase derivatives.
Exactly. And this could launch as soon as next month. It's a massive move to bring institutional-grade leverage under their watch. No new bill needed.
Okay, so this is where it gets really, really interesting. The global conflict, the standardization nightmare brewing over stablecoins.
Yes. MiCA versus the Genius Act.
And Circle is just caught right in the middle. They have 12 months to figure this out.
It's a huge problem. MiCA, the EU's big regulation, says 30% of stablecoin reserves have to be in EU banks.
Right. And the U.S. response.
The Genius Act, which, by the way, is a fantastic acronym. It requires 100% backing in U.S. treasuries.
So they're mutually exclusive. You can't do both.
You can't. Not with a single token structure.
So what does that mean for someone using DeFi? Like, what's the actual real-world impact?
It could mean Circle is forced to issue two different tokens, a USDC US and a USDC EU.
Wow.
And if that happens, you've suddenly fragmented $35 billion of liquidity. You could have two tokens, both called USDC, with different prices. That could break everything in DeFi.
So even with all that regulatory chaos, companies like Coinbase are they're moving ahead, building their own path.
They're not waiting, no.
They just launched a new token sales platform, which gives retail access to assets before they list.
Which is the first time we've seen that in the U.S., really, since the ICO crash back in 2018.
It feels like a sign that the Clarity Act might actually pass, turning these things into regulated capital formation instead of
unregistered securities.
Yes.
Exactly. It's ICOs growing up.
And they seem to have learned their lesson. They've got all these anti-dumping mechanics built in, algorithmic allocation, lockups for the issuers.
It's a much more professional setup. But what's really fascinating is how the big banks are now integrating directly. Take JP Morgan.
Yeah, the ultimate TradFi giant.
They just launched JPM coin, which is an interest-bearing deposit token on Coinbase's Layer 2 base.
I'm sorry, on base, I never saw that coming. JP Morgan, the bank that built its own private blockchain,
is now using a public L2. It just goes to show you, Ethereum is becoming the settlement layer for global finance, even for them.
And it's not just the big institutions. Look at SoFi.
Right, the first nationally chartered U.S. bank to launch direct in-app crypto trading.
BTC, ETH, SOL, for their, what, 12 million users?
12.6 million, yeah. And they're going after the remittance market.
That's a $740 billion market.
And they're using the Lightning Network. So a user sends USD, and it just invisibly converts to pesos using Bitcoin on the back end.
The user doesn't even have to know it's crypto. They just know it's fast and cheap.
It's the perfect use case, solving a real problem without showing the plumbing.
And speaking of Lightning, Square just flipped a huge switch.
Oh, this is massive.
Bitcoin payments for 4 million U.S. merchants. And the headline, zero processing fees through 2027.
That is a huge driver for real-world adoption. Merchants can choose to get USD instantly or hold the BTC.
And Cash App is ready on the other side. They just rolled out updates for stablecoin transfers, Lightning payments, all funded from your USD balance.
The on-ramps are basically disappearing. It's becoming seamless.
That move from, zero fees to real utility is the perfect setup for our next topic, the protocols themselves. Because the market's reacted, violently to the new tokenomics from Uniswap.
41.5% in 24 hours for the UNI token. It was a massive reaction.
All because of the unification proposal to finally turn on the protocol fees.
It's that critical shift toward real value accrual. They're activating a perpetual token burn, a one-time burn from the Treasury.
And the new V4 hooks, right, to make Uniswap an aggregator.
Exactly. It becomes a fee collecting machine.
But before this fee switch, everyone was looking at these astronomical trading volumes. What's the real story now that real money is on the line?
This is probably the most important takeaway for anyone listening. Once you filter out all the artificial volume, the wash trading, the true projected revenue for Uniswap on Ethereum for 30 days is closer to $6 million.
6 million, not hundreds of millions.
Not even close. Before, with zero fees, it was easy to wash trade. We saw pools with $5 billion in volume coming from just 14 traders.
Wow. I saw one report of a trader doing $1.8 billion in a single day just trading against themselves.
Exactly, just to farm yield. The fee switch forces those people out and shows you the real, genuine value capture.
So it's a reality check.
A huge one.
Yeah.
And you can compare that to a project like Aerodrome, which is already executing what we'd call the blitzscaling playbook.
Okay, but people are talking about their emissions. You've argued it's not cash burn, it's equity distribution, and you compare the inflation rate to gold. Is that a fair analogy?
I think it is. And it's backed by the data. Yes, there are emissions, but almost half the AORO supply, 49%, is locked as VRO.
Core governance.
Right, which keeps the real circulating inflation around 5.6%, which actually is comparable to gold's annual supply increase. They're giving equity to users who commit long-term.
Let's zoom out for a second to the more foundational, almost philosophical challenges. We should touch on the Trustless Manifesto.
Ah, yes.
It's basically a warning, right? That our hunt for convenience using hosted RPCs, centralized sequencers, is kind of eating away at Ethereum's decentralization.
And you have to see that in the context of what we just talked about. When JPM uses a service, they want speed and convenience.
Of course.
But the manifesto warns that if you rely on a centralized sequencer, one company is controlling the order of transactions. That's the exact opposite of what a blockchain is for.
So the lesson for builders isn't just go faster.
Not at all. The real metric for success should be how much trust you reduce per transaction, not just throughput. If your product still relies on trusting an intermediary, you've sort of missed the point.
Okay, finally, let's look forward. Positioning in prediction markets. The key insight I saw wasn't about some secret strategy. It was about headspace and mental clarity.
Because the game is moving beyond human traders clicking buttons. The focus for you should be on the infrastructure.
SATA, POI, L-Link.
The oracles.
The Oracle layer, exactly. Because those projects are providing the decentralized real-time data that the next layer totally depends on.
And that next layer is?
The AI agent layer. Projects like Fraction AI and Talus Labs. These are autonomous systems executing strategies 24/7. They don't need headspace. They need perfect instant data.
And we know where the volume is already. We do. 90% of Kalshi's volume is now in sports. And mostly football. That's the immediate application. Hashtag, outro.
We've covered a lot of ground today. The rules are getting clearer, if not messier, from the Bank of England to the CFTC. At the same time, the rails are opening up with huge names like JP and SoFi building real utility.
And the DAX wars are finally about real economics. real value capture.
It really feels like everything is consolidating around Ethereum as the base layer.
The numbers back that up. Over $201 billion in assets tokenized on-chain.
Yeah.
It is becoming the institutional standard.
Which brings us to a final thought for you to chew on. If the big financial players, the neobanks, the ones who already own all the users, if they're just building infrastructure like yield routers to plug into their existing apps rather than competing directly, should you, as someone learning this space, focus less on the shiny front-end app and more on mastering that foundational orchestration layer that's going to power all of it?
Something to think about as this new financial world gets built.
Keep exploring, keep questioning. We'll see you next time.
Spoken Tech for your ears.